Master your money, free your future. Welcome to Budget for Life. My name is Jeremy. I am not a professional YouTuber. I'm a financial advisor, but this video is not financial advice. I just want to talk about how GameStop's coming dilutions impact how you value their current enterprise, their current stock price. I want to show you kind of the when, how, and why that you can calculate dilution impact on their stock. Before I get into it, thank you to the subscribers, the commenters, the viewers, the watch time. I appreciate you educating yourself on the fundamental value of this company. All the earnings of this channel go to DRS Book GME shares. So far, we've been able to lock up 13 shares together. Thank you to the fans and friends of the channel who do the extra mile to help make that happen. So, GameStop is a company with currently 447 million shares, currently trading at a $21.71 per share trading price for a market cap total of 9.7 billion. So, what do we do with this valuation when we know that they have 4.2 billion that in all likelihood will be written off, right? Or not written off, but will be diluted, right? And what are those dilutions as far as how it impacts their cash? How do we think about their current stock price in light of that? What are the different scenarios? Great comment here on one of my videos, the 15x upside video, as far as valuing the asset management business. Basically, what do you do with the dilution? How do you value that? And the first thing I want to talk about is, when do you value dilution? Because there's a couple factors to think about. One is the dilution certain, right? How certain is the dilution? And in GameStop's case, the convertibles, GameStop's option to dilute these is just about certain. There is a possibility that GameStop deems it to its advantage 5 and 7 years down the road when it comes time for these conversions to happen. GameStop deems it to its advantage not to dilute and actually to pay back the money. But that would only be an even more bullish scenario if GameStop felt that way. So, base case, very high likelihood that the convertibles do dilute. The warrants, however, it's hard to say 100% chance that they will dilute. Or if you were to say 100% chance they dilute, it's like, well, but when? Because they are extendable. So we have a 32 strike on the warrants for next October. Do you say it's a 100% chance that GameStop's trading above 32 by next October? If not, what percent odds do you put it? And then you could weight the different probabilities of the dilution timing, right? And go from there. So one is, how certain is the dilution, and how certain is the timing of the dilution, right? And then how far away is it? And generally speaking, when dilution is 5 to 7 years away, it is not going to be 100% reflected in the current stock price. The closer that you get to the dilution happening, the more it is going to be priced in. And then obviously, once it actually happens, it is finally actually impacting the actual earnings per share of the company. And so at that point, of course, post dilution, it's priced in. So when GameStop raises money with an at the money offering, right, it's basically immediately fully priced in because the cash influx and the increased share count happens simultaneously. But in the case of these convertibles, GameStop receives a cash influx now, and the dilution is not for 5 to 7 years on these two different convertibles. And so, how do you impact? When do you start impacting how you value the company in light of the fact that there is this 5 to 7 year window? With the warrants, GameStop hasn't received the money yet. So you could say it's very high likelihood that they will receive the money, but when do you start valuing that into the company? Um, is kind of like to each his own. There's not a ton of clarity yet on when exactly that would happen. But generally speaking, if you were within a year of the warrants converting, then the warrants, you would actually make the stronger case, should be fully priced in or close to fully priced in now. But the thing about that is, if you want to fully price in the dilution of the warrants, then you also have to fully price in the cash influx for the warrants. And so if you're bearish on GameStop, and the reason is because of their coming dilution, well, the warrants are not a good um, they're not a good asset to point to. They're not a good dilutive event to point to because these only dilute if GameStop's trading at $32 a share or in excess of that, right? So if you think GameStop is overvalued at $21 a share, but you simultaneously think they will be able to sell their shares for 50% higher, well, then that's actually not exactly a bearish scenario, right? If GameStop can sell their shares for a time and a half what they're worth, well, guess what? They can take their shares, which are in your mind overvalued, and convert them for a time and a half extra in cash, which is as solid of a valuation floor that you can have as a company is net cash. All that to say, the convertibles, it's not like you would not price in the dilution just because it's far away, but really it comes down to how do you price in that dilution? And basically, there's a formula you can use that essentially breaks down for you the time value of money. So, how dilutive is the dilution? What's the discount rate? As in other words, what's the alternative? What's the opportunity cost? So we could use your average 10%. And then how many years away is the dilution? And so in this example, you can see that assuming the business increases in value in proportion to the dilution, which is the case, right, when you are raising funds, literal dollars, 1 to 1, with the dilution that's happening to your shares, then if you know the dilution's happening and the business value is growing in proportion to the dilution, then yeah, you have to take a present value of that dilution. It's the reality that you get the cash now, but the dilution doesn't happen until later. And so if it doesn't make sense to value the dilution as now when if you're just talking about an earnings per share basis, you have a 7-year runway where that dilution is not taken into effect. And so hypothetically, you could make a premium on those shares for 5 to 7 years before that dilution fully kicks in. So you take the dilution and then you divide it by basically 1.1 times however many years away the dilution is. So in the case of the convertibles, you have two convertibles. Okay, you've got one that's 1.5 billion, 50 million of new shares in April of 2030. And so if you take that formula, you've got $1.5 billion, right, at this conversion price divided by the current share count. And if you don't take into consideration the time value of money, that is an 11% dilution. But when you add in the denominator of this dilution doesn't happen for 4.5 years, then in today's valuation, you would call that a 7.31% dilution. Same with the 2.5 billion or 2.7 billion convertible, 93 million more shares, right? Here's your conversion rate. And so again, you take out the denominator. If time value money didn't exist, that's a 20% dilution, right? That 90 something million shares. But when you take the present value of that, in today's terms, it's more like a 10.97% dilution. The warrants are hypothetically only a year away. And so while those $59 million, 59 million shares represents a 13% dilution, you weight that for, well, it's at least 1 year away, if not more than that. You would price that as an 11.99% dilution in today's dollars. Why do you do this? Why do you discount for time? Basically, because the dilution is creating value. So the new money that's coming in is producing something for GameStop. At the very least, it's producing the cash returns on the money, right? But in reality, we know that GameStop has an intention, very clearly communicated, to maximize shareholder value through their utilization of that cash, not just for it to sit in cash forever. So, again, to look at it in dollar terms, if a company's worth $100 today, it raises 40 bucks through convertible. Well, after that conversion happens, or after the raising happens, that's $140. And then after conversion, after 40% dilution, right, you end up with a net value of zero, right? There's no economic loss from the dilution because the value of the company is growing in proportion to the dilution that the company is doing. And so when you think about their current share price at 21.61, if you were to say that the warrants will dilute in a year, 100% chance, and that the convertibles will dilute the 1.5 in 2030 and the 2.7 in 2032, then basically you are pricing in a 30% dilution today for the whatever that was, 45% dilution, you know, um, that will eventually finally um, convert. So one way you could think about the share price is what is a 30% premium to its current share price? So that would give you a time adjusted valuation. If you think the market is valuing GameStop right now in light of the time adjusted weight of dilution, you would say that a 21.62 current share price is equivalent to a $28 diluted share price. It's basically saying GameStop's, if they diluted today, or like if you fully factored in their coming dilution today, then if GameStop held, right, if the present value of the coming dilution happened right now and GameStop was still, even after those proportional shares are diluted, GameStop was still at 21.62, then that would be equivalent to saying that pre-dilution, they're really trading at a 28.16. In other words, um, let me actually do this formula real quick. Um, we want to take the we want to take this dollar per share times the current float. Basically, you're saying that GameStop right now is being valued as a $12.5 billion company, even though technically their market cap is only 9.6, in light of the fact that the dilutions are coming, and then you're just weighting the present value of those coming dilutions. If you wanted to argue that all of the future dilutions should be priced in right now 100%, then you would say that GameStop right now is basically worth $31.38 or a $14 billion market cap. Now, again, the reality is the cash has already been raised through the convertibles. GameStop really does have 9.2 billion in cash and securities right now, and they get to keep that money for 7 years, which is why there's basically a premium that they receive, right? The dilutive impact is delayed, and every year that it's delayed is another year that GameStop can continue to make money, right? Continue to make earnings per share to sweeten the pot for investors to be able to stomach the current dilution or the coming dilution. But again, if you take that time adjusted valuation, again, you also say, well, that means that the warrants are going to dilute. And if you think the warrants will dilute, then okay, you place a 1.7 net asset value on not just their book based on the convertibles, but then you add in the 1.9 of book from the warrants, and all of a sudden you are at a $17.8 million valuation just for the asset management business, plus that 8.7 floor for the retail business. That gets you a $59 per share price of what you would consider fair value for GameStop. And if you wanted to say that basically that $26 million market cap is the number that you want to fixate on rather than the dollar per share, right? What's the market cap value of the company in your fair case value, and what's it trading at right now? So if you think the market cap is worth 26 million and right now it's trading at 9 million, well, even if you say, well, that's because of the dilution, look at all the premiums that they're placing. Okay, well, the most aggressive way you could value the dilution is 100%. And if you're valuing the 7 year from now dilution at 100%, that's equivalent to you saying there is no such thing as time value of money, right? There's no discount rate. If I could invest right now in a business that will make money 7 years from now, that's just as good as investing in a business that will make money right now, right? That would be insane. But that's the most conservative way that, again, no one would do, right? No one would fully price in dilution 5 to 7 years out, realistically. But even if you said the only reason they're trading so low is because of the dilution effects, well, if you were to fully dilute them right now and they stayed at 21.58, that still only reflects a $14 billion market cap for a company that would then have over 11 billion in the bank net of any debt, right? Debt would be cleared. So then you're talking about a asset management business plus a retail business worth less than $3 billion, where we're talking about a retail business that's worth at least $8.7 billion in the floor case, right? And an asset management business that's worth a 1.7x premium to their cash, right? And if their net asset value post dilution is 11.1 billion, well, guess what? 1.7 of that is already well over that fully diluted market cap based on today's current trading price. So anyways, if you want access to this spreadsheet, of course, friends of the channel do get that perk. You can kind of look deeper into these formulas for yourself, whether you take the time adjusted method, or for example, you could even take out, let's say you take out the warrants and say, I want to fully price in the convertibles adjusted for present value, but I don't want to factor in the warrants. Well, again, then that to you would indicate that right now GameStop at $21 a share is truly reflecting a $25 present value of diluted market cap, aka an $11.4 billion organization. No matter what way you slice it, GameStop right now is priced very, very attractively relative to their book, whether you think dilution is happening or not. If you think that dilution is happening, that guarantees that you're receiving $32 a share of warrant money. It guarantees that you're receiving $29 a share for 2.7 billion, guarantees you're receiving $30 a share for the 1.5 billion. So all these conversions, all these dilutions are paying you a 50% premium to the current share price. So those dilutions only they do more to benefit GameStop's valuation and bolster their assets than they do cause dilutive effects to their market cap. So if the worst case is dilution, well, that means you're saying GameStop's going to get a 50% premium on their shares. If the worst case is that GameStop doesn't dilute, well, that means they have $9 billion right now that they get to play with for free for 5 years and 7 years. And so at the very least, you would take the present value of the cash earnings of that cash and say it's worth at least their cash plus the present value of the earnings of their cash, which is basically $400 million a year, right? So you take their 400 million a year times 7 years, right? I mean, what in the world are we talking about? 400 times 7, $2.8 billion that they're going to generate just in interest and gains, essentially, before they have to give this money back. And so that 5 billion all of a sudden turns into about 8 billion net of their debt, right? Because that 9.2 basically turns into 12, and then they have to pay back the 4.2. Okay, so you end up with 8, right? So if the bear case is that they don't dilute, you end up with $8 billion of cash, which means that their asset management business plus their retail business is currently being valued at about $1.5 billion. And that is for an asset management business that, again, would be the largest SPAC ever, all these records, all this great track record. And for a retail business that's generating $300 plus million a year of annualized income, right? So you're talking about a a fraction of a valuation, even if they don't dilute, right? No matter what way you slice it, okay, the only true bear case for GameStop is that they will be unable to make any money, and that has sailed. That ship has sailed. GameStop, the retail business, has revived itself into a cash cow in its own right, doing hundreds of millions a year in forward-looking annualized net income, net of their cost of sales, net of their SG&A. And as long as GameStop, the retailer, has a case to continue to grow, which they have the most competitive positioning in the collectible space, which is a booming industry, right? Not to mention the resilience of the video game industry and the console industry. All that to say, there's really no realistic downside, dilution or not dilution, as it relates to GameStop. And if you want to be bearish on GameStop, the only thing you can hope is that collectibles just poof go away, right? That all of the momentum and all of the demand ultimately for alternative stores of value somehow just goes away, which basically means you have to be very bullish on fiat currency. And if you're very bullish on fiat currency, well, GameStop happens to be one of the most cash-rich companies in the US, right? As far as relative to their market cap, it's a very, very defensively resilient company right now as structured. And again, their collectibles right now is growing 150% plus year over year. And you have to hope that that just evaporates if you think GameStop won't be able to justify the current market caps, whether you believe in dilution or not. Okay, hope you learned something in this video. If you did, leave a like, give me a subscribe, give me a comment, keep the conversation going. That's all I got for y'all today. I will see you in the next one.